All right, let's give you that markets update now. And local trade will be hoping for gains at the start of the week after weak trade for most of last week. The JSE losing for the sixth consecutive session on Friday, with the all-share index down 8% this week, and also erasing the 2023 gains as the prospects of more interest rate hikes in the United States and a shaky Chinese economic recovery dampening the market sentiment. Gary Booysen is portfolio manager at Rand Swiss, joining us now for a quick overview of the JSE and how it is shaping up this early Monday morning. Gary, good morning to you and thanks for your time. Let's start with that overall look at the markets. How are they faring in early trade?
So we're up about a 0.25% on the all-share index, which actually takes us back into a yearly positive gain of 0.04%. So nice to see that the market is actually positive for the year again.
Yeah.
We're kind of flirting with that 0% level. But this is on the back of a stronger European market. We've got the FTSE up about 0.2%. The CAC in Paris is also up about 0.5%. But this is coming off a very weak Asian market. So we had the Hang Seng, we have the Hang Seng down around 1.5% currently. And that's after the Chinese stimulus measures that were put in place this morning didn't match up to what the market was expecting. Just not quite enough. A little bit coming through, but not enough. The rest of the indices also following suit. So we have the financial index largely flat, but the industrials up 0.27%, while the resource index is gaining nicely up about 0.4%.
Yeah, let's talk commodities. Oil prices up today as the global supply tightens with the lower exports from Saudi Arabia and Russia. Talk us through those developments.
Yes, we've got Brent crude oil trading just above $85 a barrel. And as you said, I think the concerns at the moment are that global growth is going to be slightly weaker. There's definitely jitters. We're seeing it feed through from the equity markets. But with the export figures just showing that China is, instead of importing oil from the likes of Saudi Arabia, is actually drawing down on its existing inventories. And that, as you say, both Russia and Saudi are now going to produce slightly less, or the expectation is that they'll produce a little bit less. That's going to constrain supply. The idea is that maybe the supply is going to be more constrained than the growth, because while there are nerves around global growth, the US is still very, very strong, and we're seeing that in a number of US economic data prints, and that should be supportive of oil prices overall. So we do have oil prices up slightly on the day. We also had a Baker Hughes report on Friday that just showed that the rig count in the US had also fallen by 5 to around 520 active rigs, and that's a very early indicator of what is going to happen with US supply. So supply seeming a little bit more constrained, while obviously demand is still there, but a little bit of nerves as well. So slightly stronger on the day.
Let's talk company news. Thungela Resources Limited releasing its 2023 interim results, including an announcement of a cash dividend. How have they fared in the period under review, particularly, Gary, if you compare their results to those of Exxaro's, which were published last week?
Yeah, so if you look at it, all the coal producers are obviously suffering with the slowdown in coal prices. So if you look at the realized export price for coal from Thungela, you're looking at about roughly $105 per ton. The benchmark coal price is down to $129.50, so that's also dollars per ton, and that's a big drop in coal prices. So clearly that's going to affect their revenue. We've seen a 45% decline in revenue just because of the prices. Their volumes are actually up over the period, but obviously with their product price falling, that's not going to be good. You can see the earnings also, big earnings drop, so about 6.6 billion drop in profits. That's down from around 9.6 billion last year to only 3 billion this year. And the dividend obviously being slashed on the back of that as well. So they have declared the 10 Rand per share dividend, but that is down significantly from last period. And that's, as I said, coal prices are the main culprit, but also, of course, the logistics issues that they're having, specifically with their rail infrastructure, Transnet just showing on the Northern Corridor a 13% drop in volume. And that's obviously going to feed into both Exxaro and Thungela. You can't export coal if you can't get it to the ports. And that is one of the major challenges for the business. Longer term, the CEO has been fairly optimistic, just saying that, the weaker rand has helped to an extent, but there is longer term support for the industry. We're still seeing, coal-fired power stations being built in China, and from emerging markets, coal will remain a key strategic asset. So we're not going solar just yet. So largely this is coming off a very high base, and the market, I think, digesting it well. No big moves in the share price.
Sure. Let's conclude the conversation with Curo Holdings also posting its results for the 6 months, which ended on the 30th of June 2023. How are their numbers looking?
Much better than Exxaro. So education, obviously, are far more inelastic than coal prices. And we've seen a 3% increase in their learners, so now servicing 72,385 learners, which is decent. In a schools business like this, as you reach capacity in the various schools, you tend to get an earnings uplift as well. So headline earnings per share up 26% to 34 rand, at least 34.6 cents per share. So looking decent. Very good set of results in the 6 months. No dividend declared, but this was in line with what they did last time, and they still have committed to paying out 20% of headline earnings per share. So we'll wait for the full year on that. But overall, it looks like a robust performance for the private education company.
Well, good news for them. Thank you very much for that markets update. Gary Booysen is Portfolio Manager at Rand Swiss.